Thank you for joining me for this presentation. My name is Brad Renard. I'm the Chief Publisher at Upside Options. The date is November 3rd, 2019. This presentation is entitled Broad Market Update. Let's look at the charts and the economic data, and update on our conservative, non-directional, income-generating, all-weather Pinnacle strategy. That's up 41.3% year-to-date after commissions. Questions that I'll address during this presentation. The S&P 500 index just broke out to a new high. Will it hold, and how high can it go? If the market falls again, how low can it go? Do we see a recession coming? And as a reminder, when recessions hit, it usually hits stocks by minus 40 to 50%. What will be the best investment strategies for the balance of 2019 through Q1 of 2020? Passive buying of index ETFs, or stock picking, or a non-directional trading strategy? Should I sell some of my passive ETFs? Should I add short exposure to my portfolio? Should I trust my financial advisor with all of my money? And as a reminder, they usually just buy the broad-based ETFs, also known as buying the market, and they hold. And finally, I'll provide an overview and update of the Pinnacle strategy, and I'll analyze a recent trade. This is a screenshot off of the website upsideoptions.net. It just shows the returns, and it's showing a 41.3% ROI year-to-date compounded, including commissions. All returns can be verified as trades are sent to 3 brokers for the auto trade program. Available strategies. We have the Big Cap Alpha. That buys stocks with strong technicals and fundamentals with a market cap of greater than 10 billion. We have a small and mid-cap Momentum. That buys stocks with strong momentum and a market cap of 250 million to 10 billion. We have Sector Rotation. That buys the strongest stock within the strongest industry sectors. We have Contrarian Fund, and that buys stocks that have been out of favor for 6 to 12 months and they're starting to recover. Then we have Condor Pinnacle, and that's the non-directional income-generating, conservative, all-weather, options-based strategy, and that typically generates 2.5 to 5% per month. And that's what I'll spend a little more time on in this presentation. I have just 2 more slides on the company, and then I'll jump into the charts and into the market update. For our differentiation, we do 4-level quantamental analysis, where we blend technical, fundamental, and factor-based quantitative analysis. We're also long-short, and recently we're moving to 75% long and 25% short in our stock strategies. We also have a unique methodology for opening the shorts, and it makes the short trades almost free, so we can keep the trades open continuously. We follow strict exit rules, so we're able to let most winners run, but our exit rules are fast enough so we can lock in the gains and to protect capital. So for example, in 2018, October 2018, that was just before the big correction that lasted for 3 straight months in the last quarter of 2018, where the market pulled back 25%. We went from 75% allocated to 15% allocated in the 6 days just prior to that pullback. I could not predict what was going to happen. All I know is that our exit rules were triggering and we were following our rules. And every day we were selling stocks because the exit rules were triggering. So for our strategies, we finished 2018 in the plus 18 to plus 25% gain range, where the benchmarks, such as the S&P 500 or the Russell 2000 small cap index, they all closed 2018 with negative results, minus 8% to minus 12%. So we beat the indexes by a wide margin in 2018 because we follow strict exit rules. More on the 4-level scanner. Step 1 is we do macro analysis. At the big picture, we're looking at technical, breadth, fundamental, sentiment, and that modulates our bullish and bearish exposure levels. Step 2 is a technical scan, and we're finding high probability setups in the charts. Step 3 is a fundamental screen. So we're looking for strong companies or weak companies. Strong companies for the bullish trades, weak companies for the bearish trades. Step 4, we do a quantitative screen for probabilities of a pattern following through. And this is basically econometric, factor-based quantitative analysis. It's using multi-regression analysis, and it generates a lot of probability numbers, and then we use those probabilities to help us make our final selection of stocks. Finally, we use technicals to trigger our entries and our exits. And finally, we allocate about 4 to 5% of the portfolio to each position. Regarding quantitative analysis, it's basically the use of econometric statistical mathematics to provide predictions, such as probability that a stock will break up or down through a particular level, and probability that a stock will move a particular magnitude up or down once it breaks through a level. Factor-based quantitative analysis requires several years of education in econometric mathematics and statistics, along with 2 or more years of experience in developing and optimizing models that offer predictive significance. And here's what the output looks like. It's basically a spreadsheet. Our system usually analyzes about 3,500 stocks. You see the stock symbol on the left, and then we get all these different probabilities based on certain scenarios. So we use this as a final screening mechanism before we make final selection of adding stocks to our portfolio. So I just wanted to give you an overview on what it means and what the output looks like when we do factor-based quantitative analysis. Okay, let's jump into analyzing the market as we see it today. So snapshot of the current market. Stocks have been sideways, choppy, and range-bound for about 2 years and have gone nowhere. However, some of the indexes have recently broke out to new highs. So that is a big change. It's been almost 2 years where the market has gone nowhere, and now we're starting to break out. So can we trust this rally? The talking heads may say that the market is up 30% year to date, but that's an aberration because the market sold off 25% in Q4 of 18 and then rebounded in Q1 of 19. Non-directional strategies are working well in this market, and I'll talk more about Pinnacle at the end of this presentation. Buying stocks or ETFs have been struggling in this market because it was easy to get chopped up. The China trade war has been causing a slowdown in China and the U.S. economy, slowdown in global economies, a flat yield curve predicting further slowdown in the U.S., and the 10-year Treasury rate is down to 1.7%, telling us that cash has been moving into U.S. Treasuries, bond funds, and defensive stocks pretty much all year. Here's the yield of the 10-year Treasury. It's currently sitting at 1.72%, and we can see that cash has been flowing into bonds, pushing down the yield or the interest rate on the 10-year Treasury all the way down to here. And this is basically telling us that the smart money, the money that's going into bonds, is saying that this U.S. economy most likely is going to slow over the next 6 to 9 months. Here's a picture of the yield curve. One way of looking at it is the difference between the interest rate of the 2-year Treasury and the 10-year Treasury. And we can see that there's not a big difference between the yield of the 2-year versus the 10-year. And this tells us that the yield curve is very flat, and it's been dropping pretty much over the last couple of years. More on the yield curve. Here's what a yield curve looks like. So for example, a typical yield curve is upward sloping. So over here on the y-axis is the interest rate of the Treasury. And then this is down here on the x-axis, this is the years to maturity. So we have 3-month, we have 2-year Treasuries, 5-year, 10-year, 15-year, 20-year, and 30-year. And usually if the bond has a longer maturity, it will be paying a higher interest rate. And this is a normal, healthy economy when you have an upward sloping yield curve. Right now, unfortunately, our yield curve is more flattish to actually inverted, meaning the short bonds have a higher interest rate than the long bonds. And that represents an unhealthy bond market predicting a slowdown in the U.S. economy. Looking at the big picture of the market, which we call macro market analysis, first thing I want to look at is the S&P 500 index. This is the SPX. S&P 500 has 500 large cap stocks in it. This is a weekly chart. This goes back to 2015 through present. Each candlestick represents 1 week of trade. I show a 17-week EMA, that's an exponential moving average, and I show a 43-week EMA. In general, what I'm looking for is a crossover. Whenever the 17 crosses above the 43 and stays above the 43 EMA, it tells me that the stock market is in a long-term confirmed uptrend. Then, whenever the 17 crosses below the 43, it tells me that we need to be very careful. It's telling me that the market most likely is in a long-term confirmed downtrend, but it needs to also be validated. So I don't go just by this indicator, but this is one main thing that I watch. And right now we can see as present, the 17 is back above the 43, and this market just took out some new highs. So right now, the overall stock market is in a long-term confirmed uptrend based on this weekly chart and looking at the 17-week EMA and the 43-week EMA. Macro market analysis continued. Let's look at corporate earnings. Corporate earnings are very important to follow because they ultimately drive the stock market. S&P 500 companies are projected to generate about $175 worth of earnings over the next 4 quarters. And looking at this chart over here, the blue is the price of the S&P 500 index. And we're using this y-axis over here for the S&P 500 index. And then the black line represents forward 12-month earnings per share for the 500 stocks that are within this index. And we're sitting at, this one's showing about $178. I actually estimated at $175 worth of earnings. So now to get what the market's trading at, what multiple is trading at, you basically take where the index is currently trading, and the S&P is around 3,060 divided by $175 worth of earnings, and that gives us a multiple of about 17.5 times forward earnings. And the market is classified as slightly expensive at 17.5 times earnings. Corporate earnings growth has been slightly negative over the last 2 quarters, and it's probably going to be negative again for Q3 19 earnings. But so far, the market's okay with it because we had really strong earnings last year. And sales growth is also okay. For the top line, for revenue growth for the 500 companies, sales growth is good, coming in around plus 4%. Macro analysis continued. Let's look at the economic data, and this is all positive data. Core retail sales, this is consumer spending. This represents about 70% of the U.S. economy, and it looks good. This is year over year, and it's climbing. So consumers are still spending money. This is the conference board. This is a group of economists that analyze the market, and this is based off of a dozen indicators, and their leading economic indicator is still upward sloping, so that is good. They are saying that the economy has slowed and will continue to slow, but overall the economy is still going to continue to expand. GDP, gross domestic product, this is coming from the Atlanta Fed. They have very good models. Their analysis says that GDP is going to be around 1.1% for Q4 of 19. Overall, most economists believe that economic growth is going to be around 1.8%. So the Atlanta Fed is a little low at 1.1 versus consensus at 1.8%. And consumer credit, the more credit that is offered to consumers via credit cards, consumer loans, auto loans, the more that they're going to spend, and that again represents 70% of the economy. So consumer credit has been very strong, and that still looks good. Macro analysis continued, economic data positive. Non-farm payroll changes that just came out, and we had about 128,000 jobs that were added to the economy. That looks good. Hourly earnings are rolling over a little bit. This came from the employment report, and it still looks good. It's been upward sloping. It has rolled over, but this is still too early to come to any conclusions on trend other than it has been climbing. So hourly earnings have been upward trending, meaning more money going into people's pockets when they're working. Unemployment rate, we're at an all-time low, around 3.6%. And unemployment claims, this is the rate of companies firing people. This is still dropping and dropping, and this is down to a low that we haven't seen since 1969. So that still looks good. So the jobs market is still strong. More on the economic data. This is probabilities that the Fed will lower rates again. And now this has changed. So they lowered rates 3 times already. Most likely they will not lower rates again unless the data really demonstrates to them that they have to lower rates. So the probability of them easing again during their December meeting is now just 12.5%. In general, the Fed has been dovish and they have been lowering interest rates, and that's good for stocks. Interest rates are low. This is the yield on the 10-year Treasury. It's around 1.7%. So on the positive, this is good for companies because money is cheap and they can borrow money to buy equipment and do what they need to do. Core inflation is sitting around 2%, actually under 2%, 1.6 to 1.8%, and this is good. So that allows the Fed to feel comfortable that they can lower rates more if they need to. Real GDP, this is just another picture of it, and we're sitting around 1.8% to 2% for GDP growth. Personal income and spending represents how much money is going into consumers' pockets and how much money is coming out of their pockets to buy stuff. So personal spending in general has been pretty good. Now it's dropping off, but it still has been positive. The income is this line right here, and this is a year-over-year income, and it's up in there and kind of in the plus 4% range year over year. So consumer income and spending looks good, meaning they're still going to the mall, still going to the stores, still going to Amazon and buying things, and that drives the overall economy. On the negative for the economic data, the ISM index, this represents manufacturing in the United States, and it has been slowly declining, mostly from the trade war causing this. And it is now sub 50, and anything under 50 represents a contracting manufacturing base in the United States. Manufacturing these days only represents 15% of the U.S. economy, so it's not a huge problem, but it still says that manufacturing in the United States is pretty much in a recession right now. ISM Services Index, now this represents the balance. We're mostly a services-based economy these days, and it has rolled over. It's down total. The blue is just at 55, 54. We want it to stay over 50. Right now it is still in expansion territory. Non-defense capital goods, this represents business spending, and it has been rolling over. It's down near 0% growth, actually under that. This just further reinforces the fact that manufacturing is in a recession in the United States. Now I show the TNX. This is the 10-year note. I show it both as a positive and as a negative. As a negative, this is basically the smart money. The smart money in the bonds market, they're buying bonds. They're forcing the yield on the 10-year down, and it's basically saying that they believe that the economy is going to slow. So that's why it's a positive because interest rates are low. That's good for companies, but it's a negative due to what the bond market is signaling to the overall broad market. Here's the Citigroup Economic Surprise Index. This represents dozens of economic indicators, and they kind of aggregate it all together. And when it's climbing, it's telling you that the economic data is surprising to the upside. And if it's been rolling over like this over the last year, it's saying that all the economic data has been surprising to the downside or to the negative. So for the longest time, it was going down. It just popped up, and now I'm not quite sure where it's at. But at least it has rebounded, and so that's a good thing. But for the negative, it's been rolling over and negative for literally a year and a half. With regards to construction spending, it has been rolling over. This represents about 6 to 7% of the economy, and it now is below 0% growth. We just need to watch this. Right now, it's a negative. Macro analysis continued. Worldwide charts. Here's China, FXI. Here's EWG. This is Germany. ACWX, this is the world less the United States, and this is EWU, United Kingdom. So these two charts, Germany and the United Kingdom, look okay. I see higher lows. See this upward sloping line? That looks good, and they are popping up now, so that's good. China, still down here below its 200-day line, so it looks still weak, and the world less the United States is popping up, and once it gets over this line, I'll feel more comfortable that economies around the world and stock markets around the world are starting to improve. So these all were negative for the longest time, and now they're starting to show a little bit of strength. So let's look at the indexes. Here's the Dow Jones Industrial Average, 30 stocks, and it looks good. It's been grinded right up to the high, and now we'll see if it can break out to a new high, but this shows some strength. Here's the S&P 500 index. And by the way, these are daily charts. So each candlestick represents one day. I show the 200-day moving average. This is the simple moving average, SMA. And then I show a 13-day EMA, exponential moving average. And I show the 50-day EMA. That's the blue. And for the S&P 500 index, we can see that it broke out to a new high. It's over 3,025, and we're up to 3,066. The next target is 3,100 for this. NASDAQ Composite Index, this one has also broken out to an all-time high, so this looks very bullish. The Qs, this has 100 large, mostly technology stocks in it, and this one broke out to an all-time high. So that's overall bullish for the broad market. The NYSE, this one was the most bearish chart that we had. See this downward sloping line? That's lower highs and lower lows. If this index were down into this channel, it's basically telling me that this broad market's going lower. However, it's out of the channel now, and it grinded right up to this resistance level of 13,246, and now it's starting to poke over. So if this gets over 13,246 and this holds above this level for the next week or two, then I'll probably remove these lines. And it's telling me that this market wants to go higher and not lower. Small caps, IWM. Has 2,000 small cap stocks in it, and really until this thing gets over 160, it's not sending an all clear signal. These small caps need to participate, and they are. It's climbing, but it's gone up to 160 many times and failed, so we'll see. It needs to get over 160. Macro analysis continued. Corporate bonds. These are high yield bonds, HYG, also called junk bonds, and as long as it stays strong and kind of up in here, it's telling you that there's no credit stress in the high yield bond market, and that's a good thing. So that's positive for the broad market and for stocks. Investment grade bonds, this is usually BBB and above in quality. Same thing, as long as it kind of stays up here, and if it stays above 124, it tells me that there's no credit stress in the broad bonds market, and that's a good thing. Let's look at some industry sectors. There's about 80 total industry sectors that we watch, and there's probably 7 or 8 here that I watch very closely because they're more like a leading indicator. So industrials, XLI, it looks good. It trended right up to its high, and we'll see if it can break out above its high. So that looks strong. So the big cap industrials, and they tend to be global companies, are looking pretty good. Banks, KBE. We'll see if it gets over $45. JP Morgan broke out to an all-time high. For this ETF, I just want to see it get over $45.72, and then that will tell me that definitely cash is flowing into the banks. Stock market's looking better. If you have the industrials and technology and banks are leading, then overall this market's going higher. XLY, consumer discretionary, basically things that people don't need to survive, like Harley Davidson motorcycles or Whirlpool spas or going out to restaurants. So right now I'm kind of seeing this downward sloping lower high. So we just need to see if this can get higher and break up through this level here. So I'm a little surprised that we've had such bullishness in the last week, 2 weeks with some breakouts with the major indexes, and this thing is still looking like this. RYT, this is an equal weight technology ETF, and it looks really good. We're above 181, telling me the technology stocks are climbing and are strong, and that's actually pretty bullish for the overall broad market. IYT transports, rail, air, and trucking, and it has been climbing, and we just need to get over 199.62, which will validate strength in the transports, and that's a leading indicator for the broad economy. SMH, semiconductors, it's another leading indicator for the broad economy, and we can see that it has definitely climbed and took out some new highs. So these are all positives for the broad market. Market breadth. What I'm looking at here is cumulative advanced decline line. It's pretty powerful as a leading indicator. So I show for the S&P 500 the cumulative advanced decline line, and I show for the NASDAQ composite. So for the S&P 500, very strong. When I say cumulative advanced decline line, what I'm saying is that every day, for example, for the S&P 500, we have 500 stocks. Every day, we take the number of stocks that advanced minus the number of stocks that declined, and you end up getting an integer, and then you take that number and you add it to the ongoing numbers that you've added up every single day cumulatively, and that creates this chart. And you can see that we had, especially in the last month, more advancers than decliners just about every single day. That's telling me that we're probably, one, we're going to break out, because I was wondering if we were going to break out, and we finally did. And then two, how high are we going to go and how long are we going to keep on running? Now for the NASDAQ composite, you can see it's not as strong. It's not as strong as the S&P 500 index. So this is interesting, and it just tells me that we could run out of juice sooner rather than later on this uptrend that right now is momentum driven. Okay, questions we will address. The S&P 500 index just broke out to a new high. Will it hold, and how high can it go? The first question we have is this going to hold or is it going to fail? And I need this to stay over this line, 3,025, for at least a week, preferably 2 weeks. Once it starts holding over for 2 weeks, now you're starting to just say, all right, it's going to hold and we're going higher. We're going up to 3,100, maybe 3,150. Before we start running out of juice, then it rolls over. It's already retested 3,025 once right here, and that gives traders a lot of confidence that, hey, we've already come down, retested 325 once, so now we're gonna pile in and push this thing up to 3,100. I think the probabilities of it holding above 3,025 are pretty high. And then probably getting up to 3,100, 3,125, maybe 3,150, and then we could start getting choppy from there. Okay, if the market falls again, how low can it go? All right, let's go back to this chart. 28.85 is probably where it's coming down to. If we have a really hard sell-off for whatever reason, could be trade related, it could be a bad piece of economic data. The first support level is 29.45 right here. And if it comes down, pretty good chance it'll find support there. And if it's really bad data, we'll probably come down to the 200-day line and find support at 28.85. Do we see a recession coming? Probably not. Not for at least 9 months to a year. We're coming into the 2020 election. We know Trump's going to do whatever it takes to get this trade stuff behind him. They're probably going to sign a phase one deal in the next 15, 20 days, maybe 30 days. The economic data is just not pointing right now to a recession in the next 9 to 12 months. And when recessions hit, they usually hit stocks by 40 to 50%. What will be the best investment strategy for the balance of 2019 through Q1 20? Passive ETFs versus stock picking versus non-directional trading strategies. Well, since we've had some breakouts, the passive ETFs should do okay. So if you have them, hold them. If you want to get in and add a little more exposure to some of the major indexes like the S&P 500 or the NASDAQ composite or the Qs, it's probably okay. Stock picking should do fine because when we're stock picking, we're looking for the best stocks with the most momentum. So as long as the S&P 500 index holds above its breakout and doesn't fail, then buying ETFs, buying stocks should be fine. And then for the non-directional trading strategy, and I'll talk more about that, that's called Pinnacle. It's really all weather. We do it in a very conservative way, and we can pretty much handle any type of market. It could be trending up, it could be trending down, it can be sideways and choppy. Like for the last 2 years, we've been sideways and choppy, and a non-directional strategy is especially effective during the sideways and choppy times. Should I sell some of my passive ETFs? If the SPX stays above 3,025, I would probably hold your passive ETFs. Should I add short exposure to my portfolio? Right now, no. We actually paused. We've been watching this watching the markets for the last 30, 45 days and kept on seeing strength, especially in breadth, like the advanced, like the cumulative advanced decline line. And what it was telling me is the probabilities just about every week were starting to increase that this market wanted to go higher. So we just decided to pause on opening any short exposure in the portfolios. Should I trust my financial advisor with all of my money? Well, they usually just buy the broad market. They buy broad-based ETFs, they hold. Right now it's okay. They're going to do just fine. I mean, you're not going to make that much money, but you're not going to lose much either. The market is in a long-term confirmed uptrend, and we just got some breakouts. So it is okay to buy the market, hold the market right now. And again, if we start breaking below 3,025 on the SPX, that's not going to be good news. That means, watch out below and we could come down hard. Okay, let's provide an overview and update on the Pinnacle strategy and analyze a recent trade. Summary of Pinnacle. Pinnacle is a conservative, non-directional, income-generating, all-weather strategy, and it's optimized for the new political era in the last couple of years. It can handle the volatility that can come out of Washington, D.C., which can sell off stocks at any time. So it can generate positive monthly returns in upward trending, downward trending, and sideways and choppy markets. We hold a maximum of 3 to 4 positions at any one time. That represents 30 to 40% exposure of the portfolio, so it's very conservative. Each position represents 10%. Each position's open for 2 weeks. We hold enough cash in the accounts to make trade adjustments when volatility unexpectedly rises, and that can happen at any time, and it's been happening constantly in the last couple of years. So this strategy is optimized and has been adapted to this new political era. This strategy is conservative by construction, allows us to sleep well at night because we have a low level exposure, but we're still able to generate some pretty decent monthly gains. Targeted returns are 2.5 to 5% per month after commissions for the total portfolio. The strategy is up 41.3% year to date after commissions, and that's for the total portfolio. And these returns can be verified as we send the trades to 3 separate brokers for the auto trade program. Capital preservation and safety are a top priority, and we have 16 years of experience in trading this strategy. Here's a recent Pinnacle trade. What I'm showing here is a 4-legged trade. We basically are selling the 3010 call. These are the October 18s, and the 3020 call we're buying for protection. So this is a spread, a bear call spread, 3010, 3020 call spread. And then we're selling a 2855 put and buying a 2845 put for protection. And that's a put spread or a bull put spread. And these are all October 18s. And let me show the risk reward graph. So here's the first half of it. This shows the underlying. This is the SPX. This is on the SPX that we're opening. This over here represents the SPX, the value of the SPX. This is a function of time. We're showing May through September, actually through present. It shows where the SPX closed on the day that I took a snapshot, and actually that was October 4th. Closed at 29.52, and that's what this blue line represents here is the closing value of the SPX. And then these are standard deviation channels, and I'm not going to discuss that for this presentation. So the underlying is on the left side, and then on the right side is the trade. So this represents the risk-reward graph of an iron condor. The black line represents what the trade looks like at expiration. So we're just going to focus on the black line. And the bottom represents profit and loss of the trade. So anything to the right of this vertical line represents gains or profit for the trade in dollars. And anything to the left represents a loss for the trade. So we can see that if the SPX trades within this range at expiration, as long as we can stay within this point and this point, then this trade will give you a gain. Now this trade that I opened actually had a $300 gain. I had some problems with my software. This one shows a $400 gain, but I actually brought in $300 of credit, and I'll show in a little more details of what I brought in. This point right here represents the short call that I sold, the 3010 call right here. This point represents the 3020 call that I bought for protection, and it kind of creates this bear call spread. And then down here this point represents the put that I sold, 2855 put. And then I bought a 2845 put for protection. Again, this creates an iron condor. We just want the underlying index, the SPX, to stay in this trading range below the short call that we wrote, above the short put that we wrote for about 2 weeks. If it does stay in this range, we'll keep the full credit that we collected when we first opened this trade. And this one shows $400, but actually I brought in $300 for this trade. So looking at the index of where we wrote the calls and the puts, we sold the 3010, so we're kind of up here, getting close to the 3025, which is the high. And down here we sold the 2855 put. So it gives you a perspective in the chart of the SPX of where we're writing our calls and where we're writing our puts. So there's the trade. Here's the underlying over here. This is the risk reward graph for the option trade. And let's just summarize it. So we opened up the SPX October 11. Actually, one other thing is the actual trade I opened up for the Iron Condor Pinnacle was the October 11, not an October 16. I just had some difficulty with my software. But we actually opened up the October 11, 29.55.45, the same strike prices, 29.55.45 put spread. That's down here. That's 29.55, that's 29.45. And then we added the October 11, 3010, 3020. Here's your 3010, here's your 3020. Bear call spread. Add the two together, you get an Iron Condor. The put spread brought in $130 worth of credit, or $1.30. The call spread brought in $1.70 or $170. This represents quantity one. One represents $1,000 of maintenance that's being held by the broker. Allows us to open the trade, and then we bring in this credit. We brought in a total of $300 of credit, so that came into the account. So the risk is actually $700. It's not $1,000. Broker holds $1,000, but $300 of credit came in. So for the trade, to calculate the ROI, it's $300 divided by 700. You don't divide it by 1,000, but you divide it by 700. And that gives about a 43% ROI in about 2 weeks on this trade. And for a full 10K portfolio, the return would be about 3%, $300 over 10,000. We allocate 10% of the portfolio to this trade. And this is a higher credit, by the way. Usually we're bringing in more like a $2, $2.20, $2.40, but $3 is high. We were able to do this because the volatility was elevated when we opened up this trade because the market just pulled back. VIX went up to 20. I think we opened this trade when VIX was at 18, something like that. Okay, so that's a recent Pinnacle trade, and this is for the October 11. And so it's open for even just slightly less than 2 weeks. Let us do the heavy lifting. Consider trying Pinnacle for free, and we do the analysis to find the best trades, and it's recommended to auto trade, where we do the trading for you in your brokerage account. We open and close all trades. No action is required by the auto trade client. And when we have to make adjustments, things can get fast moving. So it is good to auto trade the strategy. Again, here's the summary of our strategies that are available. Big cap alpha, small and mid cap momentum, sector rotation, contrarian, and then the Iron Condor Pinnacle that I just talked about. So thank you very much. I appreciate you joining me for this presentation. Free trials are available at upsideoptions.net/free-trial. We also do a very robust weekly analysis, and that's free. It's on the website, upsideoptions.net/weekly-market-update. And if you would like to send us an email, please send it to support@upsideoptions.net. Thank you very much for your time, and I will see you next time.